Famous investor calls for a 50% crash and in fact says the crash has already started, number one. And number two, it is unstoppable, that the Federal Reserve or anybody else will not be able to step in and stop this crash from hitting his 50% target. And I'll explain why. Ready? Let's dive in. Jeremy Grantham is the co-founder of an asset manager, GMO, based out of Boston. And to be honest, you do need to take this with a grain of salt because Jeremy Grantham is one of those who has been in a constant bear mode for decades, predicting crash after crash after crash, and it only is a matter of time before those predictions of crashes eventually come through because eventually crashes happen. However, he highlights three big signs that the crash is already underway and will be unstoppable this time until it reaches at least his target of 50% down from the high, and we are already partway there. The target for the S&P 500 he has at 45% down from its close on Wednesday, which would bring it down to 2,500. He says the NASDAQ may have an even larger correction percentage-wise. So what are the three signs that he points to as evidence of a massive super bubble right now that is currently under collapse? The first one is that the most speculative assets have already started to crumble. If we take a look at ARK Innovation ETF, which is full of the most speculative, the newest, the most tech, the highest growth companies, we can see that it has just absolutely been crushed recently, down over 50% since last February. This is especially shocking considering how overweight that fund is in Tesla, which has performed phenomenally over the same time frame, meaning that almost every single company inside this ETF has done exceptionally poor. The second piece of evidence that he points to is the Russell 2000, and normally in a real bull market where there's economic growth and strength, the Russell 2000 outperforms the other indexes, but recently the Russell 2000 has severely underperformed, indicating that this is not a period of real growth. This is not a real bull market. This is what some call a blow off top before a crash. And the third sign that Grantham points to as evidence of the top here and the start of a crash is what he calls crazy investor behavior. Basically, when you have market participants that are, number one, getting extremely wealthy, mind-bogglingly rich off of investments that are brand new, untested, and in the real world have yet to prove any significant increase in real world value. Things like the dot-com bubble, where you had companies going public with massive valuations simply because they had a website and no business plan, no revenue, nothing else. That was indicative of a bubble. Now, he didn't talk about this, but usually the reason why this is something that coincides with tops right before crashes has to do with all of the new money that has been coming into existence either through artificially low interest rates and bank credit expansion or government deficit spending financed by a central bank. Both of those will expand the money supply, and that new flood of money finds its way into speculative assets that make people feel rich until people actually try to cash in on all those riches, all that new wealth, and realize there's actually nothing there. And all you have to do is look around at things like NFTs and meme stocks, altcoins, many new speculative tech companies, including the recent SPAC craze and all of the new IPOs that have IPO'd over the last year or so that are now underwater. There are little signs of bubble behavior everywhere, all a result of all of the new money coming into the system trying to find profits. It creates a false wealth effect. And don't get me wrong, I'm not saying that any of these companies, any of these space travel companies, electric vehicle companies, NFTs, meme stocks, don't have real world value, especially long term down into the future. I am saying right now they are all showing signs of either current bubble or just recently popped bubble behavior. Now, the final straw on the camel's back here is that the Federal Reserve won't be able to do anything about the next crash when it comes, and this is where I disagree with him. If you look at the traditional tools, and by traditional I just mean what they did last time, they're going to have far less of an impact as they did last time. But that's the way it always goes. Dot-com bubble burst, all they had to do is drop interest rates a little bit. Fast forward to the financial crisis, Dropping interest rates wasn't enough. They also had to start up major QE. Fast forward to 2020, they couldn't rely on just those two things. They had to also add in purchasing corporate bonds, funding massive trillions of dollars of federal deficits to bail out the entire economy. So what we are going to see is, again, another escalation. They're going to add new things on top, like universal basic income and buying stocks most likely. And then they're also going to do more extreme versions of what they've already done. So buying more corporate bonds, more high yield bonds, dropping rates all the way to zero across the yield curve. And I think it will be effective at stopping the crash. The only problem is what it does on the other side to the currency. So time will tell. Ultimately, it is healthier if the crash is allowed to happen, if the recession is allowed to cure the malinvestment and the misallocation of resources. We can rebuild from a much stronger base, clear out the dead wood from the forest. We shall see how these things play out, and I'll keep you updated as they do. As always, really appreciate you guys. Thank you so much for watching. Have a great day.